Hello, everyone. Happy Friday. It's August 12th. We will wrap this week today on the final bar, looking at the S&P, the NASDAQ pushing to the upside. We had all this talk about potential resistance levels, key, huge resistance levels with the S&P 4150 to 4200 being that blue shaded area on our chart for quite some time. We have powered right through that. Our market trend model says risk on, major averages making new highs. It's all up from here, right? Let's look at the charts together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. Let's use some data visualization techniques, the best practices of technical analysis, concepts from behavioral finance, thinking about investor psychology, all of that other stuff that in the end nets out to price. Price is the most important input that we can analyze. It's really an output of the market, but also an input into your investment process, helping you understand what is happening. Now, I've had a lot of great discussions this week, just in the last couple of days. My conversation with Mark Newton on Thursday, talking about the markets having a pretty good run, but the likelihood of rates going higher and stocks retracing. A couple of days before that, my conversation with Ari Wald, very bullish, very constructive, seeing full on risk on. The rest of the week here, Thursday into Friday. Thursday was a pullback day. Today's sort of a springboard, showing a lot of positive sentiment going into the weekend. We're going to look at a chart of the S&P 500, other places like the VIX, really think about what this week's action taught us maybe about the overall market conditions, starting to look ahead to the next week, the week to come, and hopefully be on the right side of things here. We have a lot of ground to cover. I'm super excited about the conversations we've had with our guests. They've been some really fantastic, thoughtful discussions. Next week, 3 solid guests lined up for you. On Tuesday, the 16th, we have JC O'Hara. We tried to have JC on this week. We had some technical challenges. We'll have him on Tuesday. He had some really good charts to share with you that are super relevant that I'm excited to share with you on Tuesday. On Wednesday, the 17th, contrarian David Hunter will be joining us on the show once again. And then on Thursday, the 18th, Jeff Huge of JWH Investments. Jeff was on our latest episode of The Pitch, had 5 really solid ideas to share with us. So I'm excited to have him back on the show coming up next week. By the way, all of our previous interviews, as always, are on our YouTube channel, also at stockchartstv.com. So check them out in either location if you're interested. Let us, also one really important thing to share with you. I am super thrilled to announce our next episode, the 2022 episode of ChartCon. If you go to stockcharts.com/ChartCon, C-O-N, you will see the webpage announcing our upcoming virtual conference. We last did this event in 2018. This is an updated 2022 version of it. It's a Friday and Saturday virtual conference, just about 2 months away. We are bringing in some of the top names in the world in the technical community and flying them to Redmond, Washington, to get all of their insights from our brand new studio. Larry Williams and Linda Raschke are our 2 keynote speakers. We have live trading rooms featuring Aaron Swenlin and Dave Landry, fireside chats with some of the best top names in market history: Martin Pring, Gaddis Rose, Ralph Acampora, Mark Chaikin, and many others. We'll do a deep dive into different sectors, some of our commentators focusing on individual sectors, highlighting key themes and identifying some top names, and then a series of panel discussions on how to manage risk, looking forward through the remainder of 2022 and beyond, a bull-bear debate on some top charts, and we'll also even bring in some pilots who also happen to be top market strategists. I'm going to sit down with Jeff DeGraff and Tony Dwyer, and we're going to share you that conversation. This is going to be a fantastic event. You can sign up directly from that page, stockcharts.com/ChartCon. By the way, you will see the price located on our page there. If you are a StockCharts member, or if you want to take a free trial, you get access to a member price which is about 66% less than what you see listed on the screen. I would encourage you as a member. It's a really good time to join this fantastic event. If you've never joined StockCharts before, take a free trial now because you can access the member pricing at this moment. StockCharts.com/ChartCon to access that fantastic upcoming event. We're really excited to present that to all of you. Let's continue on today's show and wrap the week. I want to start with a poll. Actually, we asked you recently. This is a really interesting poll, and I'll show you the chart that I want to use to sort of debrief on the results. Will the next 10% move in the S&P 500 be higher or lower? 58% of you said higher. 42% of you said lower. Tilting a little more bullish here. It's interesting. We asked this as the week was progressing and things were getting more and more constructive. I feel like going into the weekend, I set up this chart just to show you the two outcomes that we basically asked you about. 10% above current levels. Now I'm basing it on the middle of the range over the last 2 days because that's when most people were kind of answering the poll. So I thought that was a good place to start. It's around 42.30. So 10% higher puts us right above 46.60, we'll call it. That would take us just above the February and March highs, which would be a new swing high for sure. Very close to all-time highs around 4,800. 10% drop from around current levels would take us down to just above 3,800. That would put us within a rounding error of the June low. That would be back to the low from sort of mid-late July. That's a pretty wide swing either way, right? I mean, I think either one of those seems extreme, but certainly reachable. And one of those is going to happen first. And 58% of you said bullish. I did not answer this poll. I, of course, probably would have said 10% down only because I feel like we've had such a run. I could see the argument of a retest. However, if we would get 10% down, I would probably consider that one of the best buying setups in history because that would be the right shoulder of a beautiful head and shoulder bottoming pattern. It could certainly set us up for a nice rally into year end. We go 10% above these levels. We're up in this range. I would start to be very concerned if we haven't had a lot of chopping first. I would be very concerned. I'm concerned now about how quickly this market has run higher. We go another 10%, another 400 points above current levels. I'd be super, super concerned about a dramatic retracement given the extent of that bull market rally off of the June lows. Really interesting response. And thanks so much, everyone that participated in that poll. Let's continue on with our next chart, the Wrap the Week chart. This is one of those charts that I like to refer back to because it just shows you how the week has evolved. It's really easy to get caught up in what we call the flickering ticks, right? The short-term movements in the market. This is a chance to take a step back. So we're starting on the clock last Friday. We're looking at where we finished today here on Friday the 12th. What's happened in the last 5 trading days? The S&P 500 is here in black, up 3.3%. Now, this has been one of the best weeks in 2022 by far. I mean, obviously, we've had a pretty good run, and most of the top weeks have been in the last month, I would say, probably looking back at the data. But this is a pretty decent follow through to the upside. Besides Thursday's kind of pullback, everything else is sort of long and strung up into the right, particularly as the week progressed. A couple things outperformed the S&P this week. Bitcoin was up about 3.6% from last Friday. Then here at the top, we have in purple, this is actually small caps up 5%. We talked about the Russell 2000 ETF. I think it was on yesterday's show, testing that 200-day moving average. My friend Mark Arbiter shared that chart with me earlier this week, and I in turn shared it with all of you, blowing through the 200-day moving average today, actually closing right back above it, finishing the week with a fantastic run to the upside. Crude oil using the USO was up almost the same amount, 4.8%. So think about that rebound in energy stocks. That's what's driving a lot of that. Nice run higher in crude oil prices this week. Everything else on this chart underperformed the S&P 500. Here we have the S&P up 3.33% or so. In pink, we have the NASDAQ 100 up 2.7%. In orange, this is emerging markets up 2.5%. Gold price is up 1.6%. That's using the GLD. And then we had 2 of our asset allocation ETFs down this week. In red, we have, which one's this? Bond prices down 0.8%. That's using the TLT. Obviously, rates coming up a bit, particularly midweek. That's what caused the TLT to go down. And then the dollar index, the UUP, is actually down as well. So the only way that you see the NASDAQ, you see the S&P rallying to the point that it did, I would argue, is if the dollar remains relatively weak. That was a key part of my conversation earlier this week with a number of guests and on the show talking about that dollar and the weakness in the dollar giving space for growth parts of the market to do very well. That this week certainly helped the market to achieve some further upside. Let us finish this weekly wrap segment looking at the Mindful Investor Live chart list. As a reminder, this is a list of charts that I keep updated on StockCharts.com. If you haven't seen this before, go to my blog, which is called The Mindful Investor. You can get to that from the articles tab at the top of the screen. My blog's called The Mindful Investor. There's a link at the top of that page with all my articles, but also these set of charts that we're going to review now. When we look at the market trend model, no change this week from last week. Last week was when my medium-term trend model turned positive, and that was the second time you had a buy signal or a bullish signal in the medium-term trend model. The other time was in late March. So it's only twice that we've had a buy signal, and really only the third buy signal since the March 2020 low. So pretty rare that you have signals in this, and pretty powerful that it happened. Now this week we powered to the upside. Continue to see follow through with the S&P pushing higher, closing at the highs of the week. That allows the market trend model to be bullish on the medium term and certainly remaining bullish on the short term. It's still bearish on the long-term model. And again, that doesn't give many signals. Turned negative in early May of this year, really confirming this downtrend rotation. We'd have to continue to go higher. We probably have to get above S&P 4600, I would guess, to get the market trend model, the long-term model, to turn more positive. The medium-term trend model for me is my main risk-on, risk-off model. So last Friday at the close, turning positive gives me a higher conviction in taking on additional risk. And certainly that's been the play for this week, with risk assets rotating to the upside and continue to power through. My concern going to chart number 2 is just the extent of this run. The S&P 500 is now overbought on Friday's close. That's only the third time in the last year that the S&P has been overbought. The last time we were overbought was in November of last year, which was the top for a lot of parts of the market. It wasn't the top for the S&P. The S&P sort of stabilized for about a month before making a new high into January. But the NASDAQ made a new high in November and actually traded lower. Small caps, if I remember right, hit a peak there. And a lot of breadth indicators, momentum indicators all peaked in November. So that overbought condition was a sign of that. Now, it became overbought and then stayed overbought for about a week. And that's certainly something to look out for there. Before that, it was back here in July. Now, 2021, obviously a very different year. We became overbought a number of times. That was on those big thrusts higher. We would have brief pullbacks to the 50-day, and then we'd rotate and make a new all-time high. That was sort of the 2021 playbook. 2022 has been very, very different. So it's hard to really say. Right now is a lot like July of 2021 because we are in a wildly different market environment. In this environment, given the distribution that we've had, given the bear market phase we've been in, this concerns me when we become overbought in this sort of environment. Now, what I would tell you is the strength off of the June lows, the fact that we've powered above 4,200 to the degree that we have, tells me that overall we are seeing quite a rotation in risk assets to much more of a risk-on feel. I would be blown away. I would be immensely surprised if we don't have a pullback from around these levels because of the run that we've had, because of the fact that the S&P is overbought and so many other things are overbought. The fact that we are approaching the 200-day moving average, we're approaching a Fibonacci retracement level around 43.20. Those are levels we're going to be talking about going into next week, because I think we're at, yet again, another key resistance level here. A pullback, if you're wildly bullish, if you think the S&P is going to go to 5,000 by year end, which I don't think is going to happen necessarily, but it's possible. The thing you should be cheering for here is a pullback, because the problem is we've had such a run, things start to get very overextended, and then you can have some really violent drawdowns after that kind of run. Once people thrilled to have gained this amount start taking profits, and that actually provides the resistance. Look for a pullback, and I would argue most likely a really great opportunity to layer in if you've missed out on some of these rallies off of the June low. We don't have any more time for charts. Boy, Friday's show goes by so quickly. Talking about these weekly wrap charts, but a lot more charts on the Mindful Investor Live chart list. I'd encourage you to review the signals from price and breadth and sentiment. We need to take a quick break. We'll be back powering up, upgrading your use of the StockCharts platform. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. It's great to have you with us. As a reminder, we welcome your questions. We're going to do a mailbag segment here in a few minutes, and we'd love to feature one of your questions in our next mailbag, which will be Tuesday of next week. The best way to get your questions in front of us is via email, thefinalbar@stockcharts.com. And again, thank you all so much for sending some really good questions recently. As a reminder, put in a permalink, and below all the charts, you'll see a little link that says permalink. Same thing on ACP. You have a link to send us. If you do that, I can see the live chart that you're asking about. Always makes it a little easier to get inside your head a bit and understand what you're asking. We're also on Twitter at FinalBarSCTV, and we're on YouTube. So put a comment below the video you're watching on our YouTube channel if you like. Also, go to StockChartsTV.com. That's our on-demand platform. All of our great guest discussions and interviews and a lot of special events here at mid-year are all at StockChartsTV.com. Let's continue on our next segment, which is Power Up. What we'd like to do on Friday is try to upgrade your use of the StockCharts platform. By the way, we've had a lot of great releases in 2022. If you've missed any of them, go to StockCharts.com/new, NEW. You can click on our different releases. Our releases this year are named after geographical locations in Washington State. Our B or Bravo release is called Bainbridge after Bainbridge Island. We are now working on our Camino Island release, which will be coming up later this year in the fall. But in the Bainbridge release, we had a couple really cool features we've been highlighting in the last couple of weeks. Today, I want to share with you the new periods that you can use on an intraday basis. Now, if you do an intraday chart here, I'm doing a 5-minute chart of Apple going for the last 5 trading days just to show the weekly activity and show this really impressive rotation from a choppy period at the beginning of the week to really powering higher through the end of the week. Now, I'm using 5-minute candles. I rarely go down to 5 minutes, and certainly nothing less than that because I'm more of a long-term investor. I'm trying to look 1 to 3 months down the road on average. So 5 minutes is a little too granular, but if you're a swing trader, a position trader, that's the time frame you may be living in. And as a reminder, if you're looking for that sort of intraday analysis, ACP is a really good place to do that. Very dynamic charting platform. But both of these platforms are Sharp Charts and also ACP feature these new periods. So what we have done is given you the ability to chop the day into even segments. This has been a common request we've gotten for a long time, and we have created it for you. It's ready for you now. 10 bars a day means each bar represents 39 minutes. 6 bars a day, 5 bars a day, even 2 even 195-minute candles. You can do this. This has been a common request because what happens is if you're looking at like an hourly candle, you have this weird 30-minute leftover at the end of the day. This actually allows you to separate the day into even segments. If you're using technical indicators on an intraday basis, it can be a really interesting way to look at that medium-term time frame. So all of those are available to you. You can click on the period button below Sharp Charts, or on ACP, you can feature those as well. So enjoy these new intraday time settings we have available for you. Our next segment today is the Final Bar Mailbag. As a reminder, get your questions to us on email, thefinalbar@stockcharts.com. Here's question number 1. When a stock or index breaks through resistance, such as S&P 4200, when is it recommended to trade? And you went on your question talking about, is it when we first break through the level? Is it when we confirm it by doing something above there? Is it a close above there? Is it some sort of validation technique? And the short answer is it depends, right? I mean, it depends on how aggressive you want to be. I always tell people, when you approach a key resistance level, you can take a more aggressive, a more conservative version. And it's really more about your trading style, your investment process. Also, remember, it's not all in, right? I mean, it's not an all or nothing. A lot of times we oversimplify and say, when it hits some level, do I buy or not, right? Do I own this? Do I own a 100% position or own 0%, right? It's binary. You have to remember that one of the great tools you have available to you is to put partial positions, right? When we hit a certain level, maybe I take 25% of my total position. If we continue to go a little bit further, then maybe I take on an additional 50%. And then when we finally confirm by moving a couple percent above that entry point, then I complete and take the last 25% of my position. So remember, there are ways you can scale in or out, and that's a common technique so that you're not risking everything just when you touch a level. It's more scaling in, and that's more of a professional way of thinking about, more of an institutional way of thinking about how to address these levels, scaling in and scaling out, managing your risk that way. Having said that, I always talk about follow-through days. That's kind of my common way of referring to it. And so on Wednesday, when we closed above 4,200 for the first time, number one, an intraday move above a level is meaningless, in my opinion. You want to wait for a close above the level. That's step one. Then you need what I would call a follow-through day. Yesterday, Thursday, for me, was not a follow-through day. It looked like it would be earlier, but then we closed back below Wednesday's close. So that's actually not following through. That's showing you short-term distribution. Today, Friday's close, very much a follow-through day. That is telling you the level has been reached. We've seen further demand pushing price above there. There's no exhaustion of buyers. Buyers are still taking on additional risk, as evidenced by the fact that the S&P has gone higher. So I think of it in terms of the close and then follow through. But again, there's no necessarily right way. I think what's right is what's right for you, the way you like to take on risk, the way you like to manage your portfolio. But I would remind you that, again, try not to think of it in terms of a binary. I'm either all in or all out. Remember, you can scale into positions. You also can scale out of positions. So when you hit a price objective, take half of it off the table and leave the other half on there. So if the market continues to go higher, then you're still riding it in and logging those additional gains. Thanks so much for that great question, by the way. And I'm sure that other contributors on StockCharts probably have other ways they answer that question. I'll try to surface that elsewhere on the channel if I can. Next question. Seasonally, the XLK roars in July and falls off in August and September over both 20 years and 5 years. Over the last 5 years, the XLK falls sharply in September. Should we expect the same in 2022? You are bringing up a fabulous point. If you click on the top of StockCharts where it says Sharp Chart, switch it to seasonality, bring up the XLK, and you can obviously do this with any stock, ETF, any index, of course, as well. This brings up our seasonality charting tool. And what this does, it shows you a histogram going back over the 12-month period. The numbers at the top are your batting average. That's what percent of the time that the ticker you put in this case, the XLK, finished the month higher than where it started. Below, you can see the average return. It's literally the mean of the 5 periods or whatever period you put at the top. You can put in a different period. You can just drag this period back if you like, and you can see what's happened. In this case, we're going back to 2003. So we're taking in sort of the bull market that we're in now, the secular bull market that we're arguably still in, but also sort of that secular bear market, the second half of that secular bear market phase, really the bulk of that bear market phase going back there. This is what you're referring to, which is, August is okay, but September is actually one of the weaker months if you look at the average, the batting average. But in terms of average return, it's the third worst month after June and January. September actually tends to be pretty bad. If you do a relative, so if you put the XLK relative to the SPY, you can see also technology doesn't tend to do very well in September. So the markets as a whole actually tend to be weaker going into the end of this period. That's sort of the sell in May and go away thesis sort of ends September and October. Those tend to be pretty weak months for stocks in general, particularly for growth stocks. And we're looking at technology here. So having said that, yeah, technology tends to be pretty weak. Here's the thing. There's no guarantee, right? You have to remember that if 47% of the time technology's underperformed, that means 53% of the time it's actually outperformed. There have been some years where technology's done just fine in September. So you have to remember that seasonal trends are more headwinds or tailwinds. They're not absolutes. There's no guarantee that the technology sector will follow this normal playbook that's been building up over decades and decades. A particular year can be different. However, I think it's always important to remember those seasonal tendencies because that just tells you the general headwind or tailwind to think about. I'm actually going to do a webcast on this particular topic probably week after next. I'll probably be able to announce that to you on Monday and open up registration. I'll be sure to do that. But thanks so much for that question, dealing with seasonal tendencies going into the fall. Next question. I've seen at StockCharts, many analysts use $GNX or $CRB. Is there any difference in using one versus the other? And these are two commodity ETFs. So when I actually look at intermarket analysis, this is the candle glance page that I usually use. I use ETFs more than anything, right? So I use the CRB index, which is the Reuters Jefferies CRB index. That's probably the most widely followed in the institutional community, but that's been changing over time. The GSCI index, which is this one, GSG is the ETF. It's based off of that. I actually usually use this one, which is the DBC. You also have GCC. There are so many of these. The differences in some ways are subtle, but in others, not so much. It's all about the weighting and how much exposure these things have to different parts of the commodity complex. The challenge a lot of people have with the CRB index is the fact that it's really weighted heavily to the energy sector. And a lot of commodity ETFs have this challenge where you're basically looking at crude oil and then everything else is sort of secondary. Some of the ETFs, particularly the GCC, historically have done a much better job, I think, of giving a more equal weighted exposure, or much of a, sort of lessening the over reliance on energy and having more of a broader exposure to the commodity complex. And that's what I would say the main answer is. Certainly when you're looking at ETFs, there are expenses and spreads and management fees, all those other things you should certainly pay attention to as part of your normal due diligence before you're investing in a particular ETF or ETN that you haven't used before. But I would say when it looks at commodity ETFs, I would pay special attention to the sector distributions in those ETFs. I usually use ETF.com to bring up an ETF and look at their sector distributions and see what sort of exposure you have. I would do those with those ETFs that you're talking about because I think that could help you make sense of that. Those are all the time we have for questions. Again, thank you guys so much. Some of these are really more drawn out questions I want to make sure I spend enough time on. We need to wrap the show, go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here's chart number 1. We're starting with the traditional Dow theory. I actually earlier this week, if I remember right, or maybe last week, talked about the new Dow theory, which looks at the S&P 500 and the NASDAQ composite. That really gets to the essence of what Charles Dow was trying to do in the late 1800s, late 1800s, early 1900s, when he first created this concept of looking at indexes to track the performance of different main pillars of the economy and seeing whether or not they agreed. Here, we're actually looking at an updated version of Charles Dow's original methodology, which looked at the Dow Industrials and the Dow Railroads, when we can now, of course, use the Dow Transports. We highlighted earlier in this week how the S&P and the NASDAQ composite were both confirming a break above the June highs, which is a very bullish signal called a bullish confirmation. We now, as of Friday's close, have a bullish confirmation in the traditional Dow theory as well. Dow Industrials, Dow Transports, both breaking above their June highs. The Dow Industrials haven't quite made above their 200-day moving average. That might be something to certainly watch going into to next week. The traditional or the new Dow theory with the S&P and the NASDAQ is the one I follow more closely, but I think it was worth highlighting that both of these have now given a big thumbs up, signaling a broad bullish run for stocks. Chart number 2 is looking at sentiment. We didn't get to cover sentiment on Thursday's show. We missed it. So I just wanted to update very quickly. You've had an increase in bulls from last week, a decrease in bears. Bulls still outnumber bears, which is actually very interesting to me. From the mid-June to mid-August points, we've rallied quite a bit. We've had a big risk on move. A lot of risk assets, particularly growth areas of the market, even cryptocurrencies, have had a decent week, but still bears outnumbering bulls. There's still a lot of caution, a lot of disbelief on this current market. It reminds me a lot about sort of the middle of 2020. Bears still outnumbered bulls for quite some time, even after the market recovered quite a great deal. And it didn't actually turn positive until the S&P made a new all-time high in the 3rd to 4th quarter of 2020. Something to think about now that the market is rallying, sort of a wall of worry, right? Sort of this disbelief phase still very much in play as bears outnumber bulls. Finally, I'm remembering my comments, discussion with Ms. Schneider last week, if I remember right. We were talking about retail, might have been a couple weeks ago, talking about the strength of retail. We talked about the XRT, which is a retail ETF. Here, I wanted to sort of riff on that and look at some e-commerce ETFs. Here's the S&P year-to-date return down 9.4%. Amazon, probably the biggest e-commerce play of all, down 14%. But these other ones, eBiz, Online, and iBuy, all down pretty significantly year to date. But look at the recovery that we've seen in the last 6 to 8 weeks. That is the bull market case. These names continue to rotate to the upside. It might be an important chart to watch going forward. Folks, that's a wrap for this week and a wrap for our show, The Final Bar. All of our previous episodes and interviews can be found for free at StockChartsTV.com. I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.